Well, mining is having a moment again, but certainly not in the way it used to. This time it's not about digging deeper or drilling faster. It's about buying time, buying scale, and buying a bit more certainty in an increasingly uncertain world. We've seen gold surging to fresh record highs as we start the new year. I think really a mirror that's being held up to global anxiety, a lot of fractured geopolitics and saber rattling over Greenland, for example, the capture of Nicolas Maduro in Venezuela, and is that down to oil and rare earths, and a lot of disquiet around central banks in the developed world as well. Copper, meanwhile, is humming steadily in the background, maybe less dramatic, but absolutely indispensable. Dr. Copper, they call it. That's wiring the new energy transition and data centers and EVs and the infrastructure of a more electrified future. And together, these two metals are telling us something important about how capital is behaving today. Caution on one hand and conviction on the other. And instead of pouring money into risky greenfield exploration, mining companies are increasingly turning to M&A to consolidate, to reshape their portfolios, and some very interesting strategic deals as the fastest route to growth and scale. Glencore and Rio could become the world's new mega miner. We've got the Anglo Tech deal fending off BHP for now. So what does this mean for the mining deal cycle ahead of next week's African Mining Indaba in Cape Town? Who's funding the next decade of critical minerals? And why are the mega mergers back? And where do they break? Well, that's what we're going to unpack now with Craig Brewer, Managing Director and Co-Head of Origination at Absa Corporate and Investment Banking. Craig has spent more than 2 decades at the coalface of African investment banking, from corporate law to some of the continent's most significant mining, M&A and capital markets transactions. He's advised on some landmark deals across gold, copper, PGMs, coal and beyond. And he's really got a front row seat to how this global mining M&A story is starting to play out today in Africa. So I'm Michael Avery, and this is episode 99 of the Monocle Banking Podcast. Can you believe it? Well, Craig, great to have you on the show. Maybe let's kick off at the beginning. When you look back over your career, from corporate law actually to CIB, and we were chatting before we started the last time we spoke, I think it was one of the deal makers dinners. What has stayed constant for you? Is it the love of the deal? Is it the love of risk? Or is it the people element that has kept you going in a very competitive, very cut and thrust industry like corporate and investment banking?
Thank you, Michael, for this opportunity. It's good to reconnect, as always. As you mentioned, I've been in investment banking and M&A and capital markets for well over 20 years. And I think it's the continual excitement. I don't think you ever have a year where there's not some theme, catalyst, construct, sometimes good and bad, whether it's the days of COVID or now where everything is happening at a very rapid pace that drives deal making, keeps us busy. And I think anyone in investment banking, when you close a deal, the satisfaction is immense. You spoke about love of the deal. It is that. Always got to be careful because it sounds very much like Trump, who has been the biggest driver of a lot of M&A and his art of the deal, and that's very separate from what we do. But yes, it's been a fantastic run over the last couple of years, and I think for this year, starting the year off with the mining Indaba, starting the year off with, I would say in the last 3 weeks, 4 clear issues that have really given this market impetus, and those, as we know, is Venezuela, Iceland, the US Department of Justice, chasing after Jerome Powell, which in itself, it's for an authorized supposed upgrade to premises, but it just shows the lengths that Donald Trump may go to ensure that he has his people in the right positions. And then, of course, what is happening in Iran and that potential spillover into the Middle East in the sense of a change in regime, possibly, albeit remote, opening up the country a bit more, liberalization and the like. So those kind of, as you said, fractured geopolitical issues are really driving our economy. And that is reflected in gold. As you saw, it breached 4,600. And I don't think there's a cap at the moment in terms of where it can go to.
Yeah, and that has been one of the big talking points to hone in on one of those issues that you've raised. And I think they're interlinked, aren't they? This rise in the gold price over the last 12 to 18 months certainly signals that the market is very concerned about the change in the status quo and the once trusted safe pair of hands that the Fed and the US dollar-based system would provide as a backstop to the world. And that does seem to be very much in question now. We saw it very much, Craig, when the dollar was weaponized to freeze Russian assets when it invaded
Mm.
Ukraine. Would you say that was the genesis of this rally in gold prices, where, especially in the global south and BRICS countries, China, others started to realize that, well, the same could befall them, and so they've got to start looking for alternatives?
Correct. I think you saw around the Russian-Ukraine initial stages around 2022. That's when gold started to move above $2,000 an ounce. And if you turned around and said within a few short years it would be 4,500, no one would have believed you. But yes, at that point, people started to realize that the risk inherent in the dollar, some of the talk of de-dollarization, although I think that that will not happen. But why are people switching to gold apart from central banks wanting a reserve currency? The volatility in across, all these global pinch points, inflation, etc., is that with gold, when it's physical gold, there is no counterparty.
Yeah.
And that's why it proves so popular, because provided you've got it in your vault, capital, you don't have to worry about counterparty risk. And that's what's happened at the moment, even with dollar reserves, is, as you said, the Federal Reserve has always been a very conservative, backed the global economy. And now those things are changing. So that's why there's been this thrust into gold. And naturally, to your point in terms of M&A, there is still, significant gold deposits out there. But the challenge you've got in terms of a greenfield project, and when we talk greenfield, that means you've got geological mapping, and it's quite technical these days. You've done some preliminary drilling. You've tried to obtain your exploration licenses. You often have government participation in that. You've had to raise equity capital for that because you will not obtain debt funding for that very early stage exploration, etc. You then got to review the drilling results. That can take a good 5 to 8 year period before you even start getting into the project finance phase, when you go raise debt finance, etc. You start getting yellow equipment onto site. So when you go greenfields, it can be anything from 8 to 12 year period in terms of gold. Obviously shorter if it's open pit. But as we've seen, say, in Africa, and you've got the West Africa Gold Corridor, and with Ghana being the leader there's always some regulatory uncertainty as well, whether it's from government participation or what we have seen in Mali, where the government has kicked out certain miners or they've had to pay significant back taxes.
Yeah.
Barrick being one of them,
Yeah.
that actually, I think that issue may have been the catalyst for the removal of its
Mark
CEO, the
Bristow.
old Rand Gold.
Yeah.
Correct.
Yeah.
And the challenge you've got there is this uncertainty. Shareholders in terms of the gold producing shares are very concerned. And there's always been talk that should you actually, if you're a global gold producer, should you bundle together your African assets and list them separately because of the risk profile versus, say, a North American or Australian gold company. But then again, if you look at Africa, some of the yields, the open pit nature of some of the West African mines is very attractive. But again, it comes at risk. So, whether it's physical gold or the gold miners or what we're seeing more and more of streaming arrangements, all the elements involved in that full gold economy have done phenomenally well over the last couple of years.
So let's bring it back there. I mean, very interesting point that you raised about Mark Bristow and being caught up in the geopolitics of Mali being the catalyst for his demise. And we also see another South African CEO ascending, Natasha Viljoen, at the same time. So great to see South African CEOs all over the world in these trenches, so to speak, designing strategies. How would you be advising a CEO, say in a gold company at the moment? And I think here of a Goldfields, for example, and its failed Yamana bid. And Nick Holland stressed to me at the time, as he was passing the baton to Goldfields' new CEO, Mike Fraser, he said, Mike, to your point, it's very difficult to go out and develop new greenfields in this environment. We've got to acquire new ounces. We've got to look at where they are on the cost curve and all of these adjacencies to operations and those kinds of things. And the market does get a little bit tetchy when you put multi-billion rand price tags on these deals. But I mean, if they had done the deal back then, looking at where the gold price is now, it would have looked like a real sweetheart deal. But shareholders at the time voted it down. So how do you get these deals over the line?
A couple of things. You mentioned, first of all, Natasha at Newmont Nuclear, she's done phenomenally well. And they are now the leaders. There has been talk that they will refine their portfolio in Africa. And that's just because when you put those two very large organizations together, you do need to be a bit more specific. So I think there's coming there will be some disposals on that. But when you talk of should they buy, shareholders then turn around and say, well, it's very expensive. You're acquiring a company at gold price of 4.5. What happens if it drops to 3,800, which it could, as these things move up and down. And that's why I think you'll see at the moment many of the discussions and the like are done on a share basis. It makes it much easier if you do it on a share for share merger, even if it's not of equals in terms of the ratio, but you're not putting cash out. These kind of price earnings ratios where you can look very silly very quickly. And I think if you look back over the various cycles, we've seen many mining houses which are very cash flush because they're really riding the cycle. They go out and do M&A for cash, and it's dilutive, and it takes them many years to recover. So I'd say in terms of the gold sector, the mergers will definitely be, if they are reasonably equivalent size or large, on a share basis. I think when it gets to some of the smaller mines, yes, you can make a call in terms of paying cash for it, provided the yields and the life of mine is there. That's something we've also got to canvass, because all gold producers, they value their resources and reserves at a set gold price, and that is not spot. So you'll find over the years that many producers have their reserves and resources often valued anywhere between 2,800 and maybe 3,500. And obviously, as that level of where they value their resources goes up, they can mine more, they can mine further, provided they, of course, can manage their all-in sustainable cost. So again, all the gold producers do need to see what level of certainty can they place on, say, a forward view on the gold price over 2 to 3 years in terms of evaluating their reserves and actually doing their own internal mine plans in terms of brownfield developments or expanding certain shafts. It's very good news for them, because if you look at our South African gold producers, say like a Harmony or Goldfields, and even some of the tailings like a DRD, even Sibanye, it's still got quite a core gold portfolio, or Pan Africa, they've done extremely well, and they're sitting on significant amount of cash.
Given that they are sitting on so much cash, it was very interesting to hear Goldfield CEO Mike Fraser admitting to some frustration in the wake of Goldfield's Capital Markets Day late last year, when it was outlining production growth plans for the next 5 years and its new dividend policy. And his takeaway was that the market is very short-term focused at the moment. Goldfields has upgraded its dividend policy from a portion of net earnings to 35% of free cash flow before any of its discretionary capex, and it set a minimum of, I think, 50 US cents a share annual dividend. It is probably a return that's very popular in North America, along with share buybacks. A lot of analysts have been fretting, saying, well, it looks a bit stingy. It's about 10 to 11% free cash flow yield, and it looks a little bit undercooked given where the gold price is at the moment. But do you think that is the right approach, though, that despite these record high levels, we still need to see a degree of caution? Because we've seen that in the past, haven't we, where when commodity prices have been really riding the crest of the cyclical wave, one tends to extrapolate that out into the future, and then a black swan event happens, and then you can just put all of those plans aside.
I think Mike Fraser's been very clear there, and he was very clear in terms of the results release that shareholders, there must be capital return to shareholders, which they, as you've noted, shareholders do love that, whether it's in a buyback, a special dividend, depending on the tax treatment and the like. And he's been clear on that. I do not believe he's been too conservative. Goldfields has to look, they've just done those 2 acquisitions of their JV partners, which is, good housekeeping. They've got to be alive to what else is out there. I think shareholders just don't want these management teams to go out on a buying spree and just, splash the cash all over the place. So hence they will always ask for more. And that is the nature of an investor. They will want more returns. But I think he's struck a good balance. And again, just remember that shareholders have memories, and so does the market. So as you rightly pointed out, things can turn, not necessarily a black swan, but your costs could increase. There could be strikes or climate activity and mines flooded, etc. So you need to have that ability to build up that reserve and not push everything out the door in terms of dividends, notwithstanding that shareholders would want as much as possible.
Yeah. Coming back to African mining deals, how has the underwriting of political risk in African mining transactions evolved in a way that's a lot more disciplined and aware of the kinds of risks that, say, a Mali can pose? down the
Mm.
line. How are you structuring for that kind of political risk? Do you use earnouts, streaming? As you say, you're definitely using a bit more script in a larger transactions. How do you start to bring that political risk into something that you can quantify when you're putting a deal together?
It is changing, and often it goes to your valuation and purchase price. You have to have that discount for that effectively country risk or the uncertainty. You can then structure it that if it eventuates over the short to medium term without any of those risks, that there can be additional payments, etc. Again, with gold, it's a bit different from copper. With gold, you could always, it's your volume of a product, whilst extremely heavy, is quite small, as against, say, copper acquisition, we've got to rail it all the way to port. Provided you can maintain your run of mine in terms of your mine plan, the government does allow you to export certain portions and obtain the foreign currency. Because remember, with certain of these countries in Africa, you can sell certain portions, you've got to sell certain portions to the government who then on sell it. And you've got to bring back some of your proceeds to ensure that correctly so, that the country itself benefits from these extractive industries. But generally, you put all those risks into a bucket and it comes out in terms of valuation. And hence, you'll find that when you look at various multiples in the more, if you can call it, mature jurisdictions of, say, Canada or Australia in terms of gold, the valuation multiples are higher as against some of the others, whether it's Papua New Guinea, Latin America, or parts of Africa. But that's why, from a South African perspective, we have our issues. We have from energy, labor. Some of our mines are very old and deep. We do have issues in terms of some of the regulatory environment, but it is relatively stable. And that's why I think you've seen, for the first time in 15 odd years, there's a new mine being developed on the West Rand through West Wits, the
Yeah.
Australian listed company. And that is something to see. Yes, it's going to be, I think, 200,000 ounces a year, but it's a sign that even with some of the risks that South Africa has, the West Rand is a tough area, but people are prepared to put in capital, both from an equity and a debt perspective. So there is, definitely a move at these prices to re-looking acquisitions, developments, etc., which in the past people might have been a bit skeptical of.
Given that you mentioned South Africa and the policy environment, it's great to see that development out on the West Rand. If you could change one policy lever in South Africa to revive both exploration, and we know the minister said he wants to get our total and share of global greenfields exploration up from below 1% to 5%. So if we want to revive that, but also revive just project development, the overall operating environment, what would it be? What would you like to hear from the mines minister? It feels like for the last 5 years, we've been going on and on about the mining cadastre, and it just gets kicked down the road interminably. What would you like to see to demonstrate that this administration is committed to reform to take advantage of this stage of the cycle?
The cadastral system is so essential. And as you said, it's been, every time there's the mine in Indaba, we hear it's about to come through. And the contract's been awarded and they're doing this. That is so essential, because for listeners out there, it is like the deeds office, effectively, and records in detail each and every resource out there in South Africa, who's the owner, etc. And that certainty is good. But I think from an exploration perspective, we do need to think differently. I think there's always got to be a degree of shareholding by the state because it is an extractive industry. I think you need to balance that with regards to ordinary equity shareholders who are putting in the capital at great risk. Because remember, if you're going on exploration, it doesn't mean that the resource is there. And if there, is it actually economic to be able to extract? And then you've got to put in all the capital. So we do need something, to really enhance the exploration here in South Africa, because it's really dried up. And that could be in certain tax credits. You see in Canada, they've got some flow throughs where the shareholder at the top can take some of the credits from below. But that would go a long way, is limit whether it's broad-based B or the government, to a more reasonable level in terms of exploration, and give some real tax benefits to incentivize people to start looking around South Africa. And it's not just in gold. I mean, whether it's in the Northern Cape, manganese, you've seen some of the Northern Cape in terms of some of those copper deposits and whether those are of sufficient scale to actually do anything with them. We are a resource-led nation. in the resource basin of Africa. So we really need to incentivize by behavior to actually get people to commit capital at early stage developments.
I recently did a trip through the Namaqualand hoping to get the back end of the flower season, which we sadly missed. But interesting to see Orion Minerals and the OKIP copper mine and all of that being revived. And on copper, I think everyone repeats energy transition like a bit of a prayer or a mantra. Where are you seeing that demand actually coming from now? Is it EV? Is it grids? Is it data centers, AI? And where is it most durable for you on the copper story?
It's across all those data points you've mentioned. And I think we talk of energy transition, yes, and metals of the future, but effectively, even for existing electricity structures, etc., you need copper. And for the next couple of years, it appears there's going to be a copper deficit. There have been some issues in terms of production at some of the copper mines. This data center, this expansion, and you've seen it in terms of what's happening in AI and these hyperscalers and all that is happening there, they draw and require a tremendous amount of power, batteries, infrastructure, etc. So those alone, and it's not going to stop that in terms of both just data storage in the ordinary course, plus AI. And that, I think we're just at the start of that graph, will be needing copper, let alone in terms of EVs, etc. And whilst the EV rollout, I think, has been delayed somewhat, partially driven by Trump and the US and reducing some of those tax incentives, etc., it is inevitable. Just in terms of battery power and the like, EVs and electronic-driven infrastructure will be the way forward. So that's just not going to end. And that's why I think you've seen copper hit all-time high of just over $13,000 a ton. And I think it's very beneficial for our neighbors up in Africa, or distant neighbors in terms of Zambia and the DRC and to a degree the Congo. And that corridor they're now putting through to Angola, etc. That is massive, and it is going to be very long-term. I think in some of the other transition metals, say like a lithium or the like, it only takes a change in technology, and we've started to see that lithium is no longer used. It's still a necessary requirement across all batteries, but the technology can change, and it just depends on which then is the metal that is flavor of the moment. But in terms of copper, unless somehow someone magically creates a composite that has the same kind of conductivity, malleability, and efficiency that you can send electrodes through a very thin wire, copper is the name of the game. And that's why, to your earlier point, you've seen the Glencore Rio Tinto discussion in terms of a merger that's largely based on copper. And you've seen Anglo Tech, which is to corner the Americas in terms of copper production. And I'm sure BHP is looking at this thinking, what should they have done differently?
Now, what options are now open to BHP, who seem now a little cornered off in terms of the kind of land grab, because copper almost looks like the new oil, and there isn't, I guess, where the analogy falls down, there isn't the equivalent of OPEC and that kind of discipline in copper, and that's precisely the problem. There's no coordinating mechanism. There's just capital scarcity, and so it's very difficult not to be bullish in copper. What does BHP do?
Correct. I think if you just talk about an OPEC, you've seen in the DRC and a few others that try to restrict nickel and cobalt, etc. But it really hasn't helped too much. But then again, there's an abundance of surface supplies in terms of those minerals. But in terms of copper and the cathodes, you just see them on the M2 coming down to the KZN ports, or, as I said, those corridors going across to Angola. It is in such need across everything that you touch in your daily life. And sometimes, as we all know, you may be on your computer and your chat GPT is working overtime. There's some data center somewhere just burning through it, needing more and more copper.
I'm just going to ask you, as we end off our discussion, Craig, on Absa as a platform, what does bringing the Absa Africa Investment Banking platform actually mean in practice? Where would you say you're strongest? Is it structuring or distribution or on-the-ground execution? And maybe you can just share a little bit more about how you build your origination culture inside the team.
We have 14 countries across Africa, and we also use it as a bit of a hub. So we're in Lagos, Nigeria, but that means we can then cover a lot of West Africa. As I said, we're in Lagos and Ghana. Same with the East, and then Central, we're in Zambia, Tanzania, and the like. And it's that on-the-ground presence that really helps us understand risk, talk to the right parties. Then we see from ourselves here in South Africa, and we've got offices in London, Beijing, New York, and soon to be Dubai. That then gives us the network to talk to a lot of the major operators with assets in Africa, because that's what we've all also got to understand. Often the assets are in Africa, but the owners and the shareholders are outside of Africa. So you need that connectivity both in country, on the ground, and then across the globe. And in terms of mining, that's always been a major thrust. We're a Pan-African bank here, so we lend virtually across the region from project finance to capital equipment. And then our M&A, we sort of hold on to the client in terms of seeing where we can realize their strategic ambitions and ensure that we're there to help them and, if necessary, finance that. So being on the ground here in Africa gives us a proper feel as to what's happening on the continent.
And it's a very exciting time. Yes, we've got our challenges. We've spoken about beneficiation until the cows have come home. But if you look at Samandu, if you look at what we've managed to achieve there in Guinea and Africa's largest iron ore mine and infrastructure-related project, 600 kilometers of rail track. We're now producing from that. Yes, it's been fraught, but I'm still very bullish about Africa and the potential for the future. Craig, I'm sure we'll sit down and grab either a hot one or a cold one at the upcoming African Mining Indaba in Cape Town. Thanks for your time.
Thank you, Michael.
Well, if there's one thing that's clear from the conversation today, it's that mining is no longer just about geology. It's about so much more. It's about capital discipline. It's about strategic minerals, the regulatory reality, and increasingly overlaid on all of that is the geopolitics. Gold telling us just how nervous the world is. Copper telling us where it's still willing to invest. And M&A telling us how impatient capital has become with long, uncertain timelines. And Africa sits at the intersection of all of this. Very rich in resources, very short in infrastructure, and caught between its ambition and its execution or lack thereof in the past. And whether this becomes a once-in-a-generation opportunity or just yet another missed cycle will really depend not just on commodity prices, but on policy certainty increasingly and on partnerships and the quality of the capital that we attract. My thanks to Craig Brewer, MD and co-head of Origination at Absa CIB, for that deeply grounded and refreshingly honest conversation about how mining deals really get done and where the cycle may be heading next. If you enjoyed this episode, please follow the Monocle Banking Podcast. This was episode 99. Coming up next week, episode 100 will be with the founder and CEO of Monocle, David Buckham. And remember, you can share this and all our other podcasts with your colleagues. And do join us again as we continue to explore the forces shaping banking and capital and the real economy. As always, I'm Michael Avery. Thanks for listening.